And hello, boys and girls. How we doing out there? Doc Severson with you here today. Today is Friday, the 26th of July in 2019 with Trade School. So welcome aboard those of you that have decided to make the commitment to join me live here through this adventure today. If you can't join me live, if you're watching this on a replay, hello. Let's pretend that you are live. And so hopefully I can anticipate some of your questions. And I'm sure that some will come in through the live crew as well here today. Hello, Ike. Hello, Ty. Good to see you guys live. Thanks for checking in here today. Today is, we're going to have a little fun with today's trade school. One of the things that I like to do is I like to bring things or new concepts to life with you guys by aligning them with analogies that I hope you understand already. So this is one way that I try to bridge new concepts with you guys, of which options are a fairly new concept to most people. And I want to tie that to a lot of real world, everyday applications so that you can understand, really, you already know how to trade options. It's just the itty bitty mechanics that we'll get to. So without further ado, let's get going here. I'm going to go big screen, little doc. I'm hiding in the lower left-hand corner. If that gets in the way, please let me know and I will eradicate the live feed just so you can see me, like, you know, waving my hands and stuff like that, emphatically in the corner if there's a big point that needs to be made. So without further ado, let's get going here today. I'm not going to be talking about any live trading today, so the SEC will stay away from me today, hopefully. Today, what I want to talk to you about is analogizing options trades. Analogizing option trades. So giving you sort of a foothold into how you can get to know these things. Because look, by far, this is the most confusing and complex style of trading that's out there, by far. And I hate to even say that because a lot of you will, as soon as you hear like that, whoa, that's not for me. I want to keep things simple. We can keep things simple in the way you don't have to know everything there is to know about options. You can trade options without knowing everything out there. Although it does help for you to know, otherwise you'll eventually learn about all the little intricacies of options at some point, right? But you can narrow your field of focus down. So I don't want to, I'm trying to approach this so that I intrigue you, don't want to scare you off, because I really think that this is something that you'll be glad, 10, 20, 30 years from now, you'll be glad that you made the leap into option trading. Okay, so one thing I've learned along the way is it's easier to learn new material if you can anchor it to something that you already know. So a lot of people out there have a mental block with options. As soon as you hear options, like, oh God, your eyeballs roll back into your forehead and off you are going down the road on something else. Can't I just trade the spot and make money? Yeah, you can, but there's certain things that you can do to bring advantages, probability advantages, into your world. And this is what we're trying to do. We're trying to turn you into the casino instead of the other way around. So that's today's goal. Relate simple option strategies to everyday occurrences or transactions or just things that we do, right? Scenario number one, let's dive right into this. Protecting against loss. So this is something that we all do. We all have stuff, we all have things that are of value to us, whether they're tangible or intangible, and we want to find a way to protect against loss to our stuff, don't we? So you own a valuable asset. Let's say it's something tangible, like a house or a car or a boat. And I mean, these are easy. It starts to get difficult when you start talking about life insurance, right? So an insurance company can provide this function. They will offer to cover your loss for the specified term of the contract, right? It's not forever. It's not that you can go to your insurance company and say, well, I stopped paying you years ago, but I thought you liked me. Aren't you going to pay my claim? No, it was for the specified term of the contract. And in exchange for them protecting against your loss, what they're going to do is they're going to insist that you pay them some type of fungible asset, right? Money. They're going to ask for money. And we want it either on a monthly basis, or they'll just say, here's the whole policy, pay it however you want to. So an insurance company will do this. They have the right to deny you coverage if it deems that the risk is too high. They can. That doesn't make a lot of people happy with that, because you feel like you're being discriminated against, but there may be real numbers that backs up why they don't want to insure you. Your risk may be too high. The claim may be too likely. So, in line with today's session, this is a very similar scenario to buying put options in the market. Long puts. And I don't care whether this is crypto, whether this is futures options on a commodity like something like wheat or corn or oil, or the equity markets, could be anything like that. Doesn't matter. So one thing that you'll be glad to hear is that if you can learn this on crypto, and really with the very skeletal tools that are out there with crypto, you'll find a much easier time trading them with the equity markets or just about anything else that's out there. So here we look at puts in the option chain, and I'll just spend a couple of minutes on this one. So some of you look at this and are like, oh my God, look at all these numbers out there. Can I just trade the spot and be happy with it? Well, yes, you can, but it just takes a little bit of knowledge. So let's look at some of the variables here that are in the option chain. First of all, we're going to see this is the series. The series is the 2 August 2019 on BTC. And this means that this expires in 6 days and blah, 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 whatever, right? So this is next Friday. This is the 2nd of August series. The strike price is basically the price of the contract that we're buying or selling. So each one of these contracts is going to have a date of expiry, is going to have a strike price, and is going to have a bid and ask. Each one of these has got its own little market. Each one of these has got its own market. So you're used to seeing Bitcoin, which is got a bid and an ask price, and it's going to be about 9,700 right now as we speak. But each one of these has got a bid and an ask price. Now, before you ask, this is per one contract. And if I'm looking at Deribit right now, I can't buy or sell these with US dollars. They just put this on there to be nice to me so that I can have some sense of what it really means versus a fiat currency. But these are actual BTC numbers. These are actual BTC numbers. And so what you're seeing is with the put option, and notice that the price is going higher as I go down. The strike price is going higher as I go down. So the further up in price that I go, the more I'm paying for that. So what you'll see is that every option chain, and it doesn't matter whether this is crypto or whether this is equities or anything like that, they will shade the in the money options. So if you see me say ITM, that means in the money, versus the intersection of in the money is at the money. So right now the price of Bitcoin is 97.79 or whatever. So at the money is going to be somewhere in between 95 and 10,000. This is not very granular, and somewhere down the road we're going to see strike prices like 9,500, 9,600, 9,700, 9,800. Why don't we have that right now? Why don't we have more granularity than we do right now? It's because of volume. We could probably add a whole pile more strikes in here and get much better granularity, and this gives us a lot more things to do. But the problem is that there's going to be nobody trading on them. It's going to spread out the volume. And so right now, this is the best that we can do. What you'll typically find is that the shorter dated series like this will have more volume. And here's open interest. This open interest means people that are still, they're currently holding a position. Volume speaks to today. Open interest means everything that's still open right now, anybody with still an open position. And then we talked about in the money, at the money, and then over here is out of the money. Now, this is going to be opposite depending on whether you're looking at puts or calls. One of the many, many things that gets a little bit confusing as we go through this. That's okay. We got time. There's no rush to do this. Now, some of these fields that are on here, quite honestly, let's not worry about these too much just yet, just because they're going to confuse you if I start talking about implied volatility and things like that. So don't worry about that for right now, but we will get to that down the road. So these are what puts look like in the option chain. Remember, there is a expiration date. So here's the EXP, expiry or expiration date, 2nd of August. That means on the 3rd of August, these options will no longer be trading. So whenever they dictate on the 2nd of August, usually they put a time and denote it through UTC somehow. That's it. After that point, the option settles at a specific price. There's a settlement price that's assigned where you'll know whether or not your option is either in the money, out of the money, and that's all you care about. Okay. So again, a lot to this, a lot to unpack from the option chain. We're not going to get to that today. We'll get to that in the course as we go through that today. I should be announcing the course next week. So probably what we'll do is next Wednesday, I will do a live session, which is going to be more of a call to those on the outside world to say, hey, would you like to learn about options? You guys will be invited to that. And we'll see if we can get people to join the course and to join Omnia. So it'll be more of a sort of sales presentation, but it's going to be kind of like Options 101 in 45 minutes. So you'll see that next Wednesday, but what I'll do is probably Monday or Tuesday, I'll open up the course to people in Omnia. I should have enough in there to get you started. Okay. And if there's any questions along the way, go ahead and stick your paw up. We're under no time constraints here today, so I'll just keep going until I see a question. So those are puts in the option chain. So we talked about the series. I showed you the 2 August series, but each one of these is different, right? So we can go 2 August, we can go a week further out, we can go to the end of the month, 30 August, September, and even into the end of the year. I think what you'll find also is that there's some options in some markets that are like a year and a half out, almost 2 years out. And those are called leaps. Those are long-term equity anticipation securities. It's something to that degree, which we're not going to have the same name here, but they're just collectively called leaps. So I don't know if we're going to have leaps in Bitcoin options. So the longer that you want to buy this replacement coverage, so let's say you want to do a policy all the way through the end of the year, it's going to be more expensive than something which is just for a week. So let's look at this. Let's say that you wanted to protect against a move that goes down to 7,000 for the next week. Let's say that you're scared to death that you checked into Tone Vay's channel and he said that next week, I swear it's going to happen, BTC 7,000. And you say, oh, okay. You can actually hedge off an entire Bitcoin's worth of protection to the downside for somewhere around, let's just say it's about $9, which is pretty reasonable, right? It's pretty reasonable. But you've only got 6 days of protection of that. If it happens after that, you are out of luck. Or what you can do is you can say, well, maybe it's going to happen sometime. Maybe this crash that I think is going to occur is going to happen sometime in the next 153 days. Okay, let's see, 7,000. Oops. Wow, it's going to be $900. So it's 100 times more expensive than this policy. Okay, this is the extrinsic value or time value that's baked into that cookie. So time is an expensive thing, which is why we need to learn to sell it instead of buying it. Okay, so this is always the issue. When you buy an option, you're buying something, you're buying that time. Time is an expensive commodity with options. So let's talk about trading applications for long puts. What do we do with long put options? This can be used as a directional bearish trade. So I think I've seen some people even in the Omnia chat talking about, yeah, I bought some put options and, made some money on that. Okay, you certainly can use this as a directional bearish trade. And there's actually some advantages towards doing it this way. It's a leverage trade. And it will pick up value. It's almost like a stone rolling downhill as it goes down in value. And this is because of the implied volatility effect of that. Again, beyond the scope of today, but it will accelerate in value the lower that it goes, which is kind of interesting. So for this to work, the move lower must occur within the expiration. Can't happen after the expiration. You've only got the contract for that limited period of time. And will be sensitive to what strike price that you buy. If you buy something in the money, it's going to operate differently from an option that you buy at the money versus something that you buy which is out of the money. So a lot of people instantly go towards the out of the money options because they're cheaper. Well, and that can work incredibly well. But also what you're going to find is that they're very unresponsive unless you get a big move. So we can also use this to hedge a larger long portfolio. So let's say that we've got, umpteen Bitcoin, and Tone has scared us to death that we're going to be looking at Bitcoin 600 in the next couple of weeks here. And we just want to do something about it. We want to hedge. We want to protect our portfolio. Well, you can buy this insurance. This is you buying insurance by buying long put options. Now, you really wouldn't want to do this if you have a very small position. You would want to do this if you have a larger position of 1 BTC and larger than that. So it's generally a trade that you hope loses all of the premium that you put into it, right? You really don't wish that your house burns down just so that you can claim on your insurance, unless you have a really bad house, which is flea infested, right? You can't get rid of it. But that is fraud, and we're not going to talk about fraud here today. So you don't really want your home to burn down. You really don't want to make a claim on your insurance if you could help it. You're not going to be doing high fives if somebody hits your car just because, oh, well, he's insured. This is awesome. No, it's going to be a super hassle for you for the next 2 months while they try to figure out what to do with your car. Or you may not get the replacement cost of getting a new car if they total it. So all kinds of complications. So don't think about a hedge as something that you really want to use. Think about it as only insurance, as something that you hope doesn't come into play. That is long puts. So this insurance, buying puts can be somewhat expensive. You're typically buying it long term, thus paying for it a lot of time value premium. We'll talk about something at the very end of today's session today, which may be of interest to you, which is a more advanced strategy that can come into play. It's called a collar. Now we'll get into scenario number 2. So that was scenario number 1, which was buying insurance, and long puts allow us to buy insurance. So now scenario number 2, which is leveraging gains. Okay. This is where people get excited and like, ooh, this is the fun stuff. So let's say that you're going to buy somebody's house and it was a $200,000 house. You put down a $500 down payment in good faith just to set up the contract, right? So you come to agreement and they said $500 is fine. This gives you first right of refusal. That gives you a right, but not an obligation. You can back out of it. You can say, you know what? I don't want to do this anymore. And you're going to surrender your $500, for being a pain in the butt, but you can do that. Unfortunately, the seller of the house has the obligation. They have to sell you that house if you're under contract. But if you back out of it, you're going to lose your $500 deposit. This gives you first right of refusal for the next 3 months. You set up typically some contract length behind that, right? So hopefully this all makes sense. I don't know how many of you have bought or sold a house before like this, but you're in contract. You're in contract. So what happens is all of a sudden, out of nowhere, during the next 3 months, all of a sudden, that neighborhood gets to be really, really popular. Maybe they found out that Paul McCartney lived in that house at one time, and nobody knew that before. And all of a sudden, you're like, whoa, I didn't know Paul McCartney lived there. And nobody else knew that either. So a bidding war breaks out on the home that you're in contract on. And maybe you don't even particularly like Paul, right? Maybe somebody does more than you. And somebody's offering $250,000 on the house. So $50,000 premium above and beyond what you were going to spend. And all of a sudden, the seller's like, whoa, I'd like $250,000 better than 200. You know, well, they're under obligation. So they're sort of hoping that you back out. And so what happens is, perhaps your home is not selling. Maybe there's some issues on your side. So you decide to sell that option to buy to the next buyer in line who agrees to buy you out for 10 grand. So they're going to buy you out just to get you out of the way so that they can get into Sir Paul's house. You just made a 2,000% return on your $500. Pretty sweet. You know, we should all be so lucky. But that is an example of leverage. You used leverage. You leverage your $500 to be able to make 10 grand. Not happening every day, right? This is the typical scenario that you hear about with home flippers, where they will use a very small down payment or use leverage capital or somebody else's capital to be able to get that house into contract, and then they fix it up and sell it for some ridiculous amount. And they're able to flip it and keep the gains from that. So they're using leverage. So as you might imagine, this is very similar to buying call options, or we're going long calls. Long means you're buying something. So another scenario would be like buying a ticket to an upcoming Super Bowl a year in advance. You don't know who's going to be playing the game. You just know that there's the date. You can buy the ticket. You know where the arena is. You know when it's going to start. You know everything about it except for who's playing in the game. The ticket gives you the right to attend, or you can even sell that ticket if you want to, up to the expiration date, which is the date of the game. Trying to sell that ticket the day after the game is not going to, unless somebody wants it for $1 or $2 just for sentimental value. So it ends up being the Dallas Cowboys versus the New York Jets, which are two huge fan bases, and scalpers are selling the ticket at 10 times face value. Okay, you're out of there. You don't care about those. You happen to hate both of those teams, and you sell your $500 ticket for $5 grand. You make a 10x return. You had the right to do anything you wanted to. You had no obligation to go to that game. Nobody was going to put a gun to your head and said, but you have to go. No, you had a right, but no obligation. Now, the arena, the NFL, had an obligation to conduct that game. Otherwise, that would not turn out well for them. So let's talk about calls in the option chain. I'm not going to go on the same level of detail. We see the same thing here with calls. We have the series, which is the expiration date. And now we're going to be looking at things a little differently. Notice that the shading, if you can see this okay, remember the price is about 9,700, 9,800, somewhere around in there. So these are going to be in the money is up here now with the price below where the current price is. Here's at the money, which is no different. At the money, and then these are going to be out of the money. OTM, out of the money. Okay, so the same kind of thing. It's just opposite. In the money, out of the money is opposite, depending on whether you're looking at puts or calls. So we can buy options that are in the money. We're going to pay a lot more for those. There's going to be certain advantages to doing that and disadvantages. The disadvantages, obviously, that these are pretty expensive to control one Bitcoin worth of crypto. Or we can go way out of the money and spend next to nothing to control that same one BTC. We can go way out of the money, but guess what? Unless the price gets somewhere up to and beyond 12,500 by next week, then we are out of luck. We're going to be sorely out of luck, SOL. Okay, so this is calls in the option chain. Again, a lot of these fields, don't worry about these for right now. The things you want to look at is the strike prices. Here's the strike prices over here. And you want to look at the expiration, and you want to look at the bid and the ask of each option. Each one of these has got its own market. It's its own separate market from the other options. Okay, everybody happy? So the series of options determines how long that you have to control that leverage. The longer that you want to control the leverage, the more expensive the premium. Imagine if I wanted to buy a contract on a house and I said, I want to control the contract on your house for the next year. Well, first of all, if I was a seller, I would say, get out of here, hit the road. But if I didn't really care, if I wasn't in any rush, then I would say, sure, you can buy a contract on my house that'll give you the option to buy my house. We'll be in contract for the next year. This will give you a lot more time to sell your house, but I want $5,000 for my effort to take this thing off the market. So more expensive premium. So we looked at short-term versus long-term options. If you wanted to control something, like we said, you could buy this option out here at $12,000 for maybe $45, but that only gives you the right to control that one BTC for the next week. Now, if I go out to $12,000 for the end of the year, that's going to be a little bit more money. That's going to be about $1,800, maybe $1,875 to do the same thing through the end of the year. So it depends on what you want. Depends on what you can afford. But chances are pretty good that these options are, unless we see a big blast off, we're going to expire out of the money next week. So let's go into an application for long calls. What do we do with these long calls? It can be used as a directional bullish trade. It can be used. I'm not going to say you can't use it for this. You're controlling the gains and losses of one BTC at a fraction of the cost. The problem here is that this application is very appealing. This is an extremely aggressive play. You are highly likely to lose money doing this. There are so many things that you need to get perfectly right to profit from this type of trade. You're going to have IV crush. You've got to get the direction of the move correct. You've got to get the velocity of the move correct. You've also got to get the timing of the move absolutely spot on or within the field of play for you to make money from this. That's a lot for you to get right. The setup that makes the most sense to the noob, because they get excited by this and they see something just blowing up. Beware of marketers pushing this strategy and showing 10x returns. I will say, if you're looking for a directional trade with leverage and you get excited by options, then what I would do instead is I would look to futures contracts instead. They are the ideal directional trade. Yeah, there are some issues with them. They typically do have a little bit of leverage, but you can get some of these smaller options that are out there. Not options, but some of these synthetic futures that are out there, which have 100-to-1 leverage that take up very, very little capital for you to use. So that to me is a much better choice for a leveraged instrument than one of these big options that are leveraging one BTC and probably leveraging way too much for your account. Everybody happy? So those are the two long strategies, the long calls, long puts that we went over. Now we're going to flip the equation around. We're going to talk about selling options to open the position, which is something that few people have done before. Few people have actually sold a position to open it. You hear all kinds of weird things about that, but this is very, very common in the options world, and you need to be ambidextrous with this. In fact, this is what I prefer that you do, is actually sell to open. With this scenario here, which is the insurance company. So now instead of buying premium from the insurance company, like what we talked about before in scenario one, we're going to flip that on its side. We're going to become the insurance company. We can also use a casino as an example of this. They have a defined edge over their patrons. By law, they're allowed to have like a 1 or 2% edge, depending on the game. And their job is just to follow the game. They're not allowed to cheat, right? Nobody's allowed to cheat, and they're allowed to provide that business. All they have to do to make money is just follow the rules of the game. And the laws of probability will always work in their favor to create a positive return. Does that mean that somebody can't hit the jackpot? Or somebody can't, have hand after hand after hand of blackjack and, just clear out that dealer? Yeah, that can happen. But they'll probably won't allow that player to come back in the casino again, right? They're going to maintain their edge in any way that they can. But overall, I would say that every casino that I'm aware of makes a pile of money. So insurance companies are much the same thing. They do their homework and they know the statistical distribution of signing up the next customer with a policy. Is it worth the risk to allow that next customer to get a policy from it? Is it worth the risk for that casino to allow that player to actually come in? This is why they have facial recognition going on. So would you rather be an insurance company or one of their clients? Would you rather be buying insurance off of an insurance company, or would you rather instead become an insurance company yourself? The insurance business is notoriously boring. I don't think anybody's going to think of an insurance company and think, wow, they're like really super aggressive. Maybe some of their advertising policies are aggressive and catchy, but the fact that they spend so much on advertising should tell you something, that they have some pretty incredible budgets to work with. That creates steady returns. Just about every insurance company I'm aware of does very, very well. So this might be a good business model if you're a conservative trader, if you do it right. So an insurance company needs to address risk on the front and back ends of the transaction. First, by applying due diligence before they sign up any policies. So this is why they've got teams of underwriters and actuaries and things like that to examine everything from every different point of view and have statistical models in terms of knowing how much you're going to make from that next customer that they sign up. They're going to have a few outliers out there, but the bell curve is going to kick in, and 68.2% of the people are going to fit right in the center of that bell curve, and they're going to know within 1 degree of separation about how much they're going to make off of that. So is the risk worth it in exchange for the premium payment? Yes or no? If they can't say yes, then they have to decline. On the back end, they need to ensure that they control the damage from a claim ahead of time. How do you do that? Well, there's even things called reinsurance. All right, so there's insurance for insurance companies that they have a huge margin on that sort of thing. So it's all kinds of different ways to hedge off their risk on the back end. I mean, just because a hurricane comes along, I haven't seen any insurance company go out of business just because of that, right? Sure, there's some financial stress if there's one after another, but they still seem to work, right? So when we bought insurance, we were long puts. If we're going to be an insurance company, then we will sell puts to someone else. Now, who is that someone else? We don't care. We don't care who it is. I see just about every time I see people getting into options for the first time, there's always this like, yeah, but I got to know who I'm selling it to. Am I selling it to the market maker, or am I selling it to some other retail trader? Is this a zero-sum game? It doesn't matter. The market's there for everyone, right? And you don't know what they're doing. Just because you see a whole pile of puts going out there doesn't mean anything. It could be somebody hedging off a very, very long portfolio, and they're perfectly happy with letting those puts expire. So don't get too hung up in what is going on with the other person. Focus on what you are doing. The market is there for you to realize your goals and dreams. So if we sell puts, this puts the odds in our favor from the get-go, since we're selling a wasting asset. A wasting asset is like holding an ice cube in your hand in the summer. It's not going to be there for very long. It's a wasting asset. It will turn into water before long. The premium on an option will eventually go to zero. They will all go to zero. The premium will all go to zero. The only thing left at expiration is the intrinsic value. So it's also like selling gift cards. Did you guys know that gift cards, companies love to sell you gift cards? That's why, like, you go to a grocery store and there's a whole display with gift cards to Best Buy or to Amazon or to eBay or, whomever. They love to do that because 1/3 of those gift cards never get turned in. They get sent to somebody for Christmas or for their birthdays, and I'm going to get around to putting that in, and then they never do, because it takes effort to do something like that. So 1/3 are never used and they expire worthless. So let's talk about puts in the option chain. If we sell these, remember, we're going to sell these. Let's spot out of the money. So here's the deal. If we sell, let's say that we sell the 8,000. So remember, this is by next Friday. If we sell the $8,000 put, and Bitcoin is, up here at 9,700. So it's 9,700. Here is, let's just say, for instance, this is 8K down here. 8K. Bear with me here. This is doing this on my mouse. So if that's 8K, the price has to go down by August 2nd for this to become in the money. For this to become in the money, it's got to go down through here, trade below there, and actually stay there below 8,000 by whenever the actual settlement time is on that day, on August 2nd. And then you've got an obligation. You've got to buy that. You've got to buy that Bitcoin. In this case, with Deribit, what they're going to do is cash settle you, which is probably beyond today's scope. But right now, you got, for selling the obligation to buy one Bitcoin, you got something around $40 to do that over the course of the next week. Probably not worth the risk. I'm just showing an example here. But as long as the price stays up in this area, this option will eventually, this one here, which is trading for about 39 by 44 today, will eventually go to zero, because this is out of the money. This is out of the money. We're selling garbage. We're selling fluff that we hope expires. So this is the game. So longer term puts, if we were to sell that against the 8,000, whoa, okay. So we're talking, between now and the end of December, we're talking, and here's the thing about this. All right. So let's say here's 8,000. Let's say here's 8,000. This is the price. Price is up here at 9,700. Let's just say 9K for right now. Price goes down, goes under that. Do you have to do anything? No, you don't have to do anything, although you do need to know where your bailout point is. But it can dip below there and go back up again, and it's fine. It's fine. These will eventually expire. So you can have a little bit of movement underneath and get in the money on these. As long as your rules allow you to stay in the position, you're still good. So you get a lot more premium for selling a lot more time. Time is of value. Risk management is first and foremost, so that you don't get run over. So the worst things that I see when I see people selling puts is that they put them on and they have no idea where they're going to get out. Rule number 1 of risk management states never enter a position without first identifying what your exit is. No different here. No different. Selling puts, buying the spot, it's the same thing. If your asset goes to zero, you're left holding the bag, right? So that's not good. If the asset, if it goes to zero, we got bigger issues, right? That's not going to happen. But this is no different than holding the asset long anyway. It's the same risk curve. Just don't freeze and become a deer in the headlights. So trading application for short puts can be used as a directional bullish trade, can be used as an income trade on a repeated basis. This is what I prefer. So I don't typically swing these like as a swing trade. You can, but it usually eats up a lot of capital to do something like that. The returns are fairly low from this on purpose. You just want something that's easy to do, right? You don't have to be right. Remember, if we sell this put, so let's say this 8K put down here, 8K, and we're starting it out today at 9,700. It can go up, it can go down a little bit, it can go sideways, it can go anywhere like that. But as long as this thing is still out of the money by expiration, here's expiration up here. As long as it's out of the money by expiration, it expires. We're gone. We get to keep all that premium that we sold on day one. So this is where you do kind of a rolling thunder thing. You pick all these different expirations and you keep selling puts against it, selling puts against it. And you can do this continually. You can even leapfrog these things. So the odds are in your favor. However, the risk is unlimited to the downside. So if it punches through your strike and keeps on going, you might want to make sure that you have an exit point. Risk management is key. I'll keep saying that. Insurance companies are experts in the field of managing risk. That's what they do. Okay, I'll stop for a second here and see if there's any questions on that. Everybody happy? So Tig is asking, can you close the position ahead of time if you think that the trade is heading south? Yes, you can. So here's what's happened. So let's look at this option, and this is time down here, and this is let's call this value, dollar value, an option, and here's expiration. An option will do this. It will go along, and then as it gets closer and closer to expiration, it'll dive like that in an exponential curve. So it's not linear. It's not like a straight line like this. It's exponential. So the closer it gets, the faster it accelerates because there's a derivative involved. So you can do something like this. Like if it, a lot of people, what they'll do is that they'll buy them back. They'll put a good till cancel order in there for, like, if it gets down to only 25% of its value or 20% of its value, they'll close it early. And that's always a good thing to do because you're eliminating risk. Anytime you clean up risk and don't allow yourself to get taken out by something that's unexpected, it's always a good thing. But the point I want to make to you is, like, from day one, you're probably going to be in the hole a little bit because there's the bid-ask spread. But time value will start to eat at that option. So maybe the price is it's going up, it's going down, it's going up, it's going down. Even with the passage of time, the value of the position to you is growing because that ice cube is melting and your obligation is shrinking more and more. So a lot of times what you'll do is, like, you'll set up that limit order and it may fire like here because maybe you had a quick little rally up and it's also eaten enough time off of there. But to answer your question, yes, you can always close these early. You don't have to be, tied to the pole and waiting for, waiting for the buffalo to run you down. You don't have to feel like you have a bullseye in your forehead. You can always close them down. So the fourth scenario, and this is the last one that I have for today, is that of the landlord. And let's be nice. These are good landlords, right? Not evil, not slumlords. These are good landlords. Real estate ownership is a great business. Everybody agrees with that. Land will only appreciate in value over time. That's what we found. Some do it even better than that. They rent out their land. They make money off of the land that they own. Okay, so that's like the perfect world, right? Is you own the land and you can actually make money off of it. A fast food restaurant is a great example of that. Their primary business is real estate, believe it or not. And they just happen to have a little business on top of it. Someone who owns and operates a self-service storage business. That's harder to say than I thought it would be. A car wash is an example of a real estate business at its core. They're in the real estate business. They just happen to rent the land out and create income from it. The way for any landowner to augment his profits is to rent out space on the land, like apartments, Hey, I'm awesome. I'm a real estate owner. I just bought an apartment building. And somebody comes up to you and says, oh, well, what is your occupancy rate? Huh? What? You mean I can rent these out? Yes, of course. That's the whole idea, is you want to rent out your assets. If you're an asset owner of Bitcoin, you can also rent out that asset just as if for land. And in this case, what we're going to do is we're going to sell call options. Selling a call option will give us an obligation to sell somebody the asset at that strike price. So let's say, now we're going to be talking about this in the opposite manner. Let's say Bitcoin is just fumbling around here and we sell a call option up here at, let's just say 11,000. So we sell a call option up here at 11,000. Here's the expiration date. And now we have the obligation to sell somebody Bitcoin. This is different now because we've sold a call option. We have to sell somebody Bitcoin. Selling a put option was we were obligated to buy Bitcoin. Now we have to sell somebody Bitcoin at 11,000. You might imagine that if the price rockets up to 13K here, that would not be good because the price is 13K, but now we're obligated to sell them at 11,000. That's not very good. Okay, so we'll never do this naked. We'll never do this as a naked trade. Okay, excuse me. What we don't want to do is we're not operating rent to own. We never want to sell somebody that apartment building. So all we're trying to do is just to keep the asset and remain collecting rent. Selling a call option is selling a wasting asset that decays on a daily basis. This is what we want, and it puts the probabilities in our favor. So it's the same thing, it's just flipped around. So let's look at this, short-term versus long-term options. And let's see, where is the at the money here? At the money is right here. And at the money is right here. I know this is very subtle with Deribit, but many of them are very subtle like this. So notice that when we're selling out of the money calls, so let's say the 12,000 for next week, that's only bringing in, $45. But if we sell the 12,000 for the end of the year, again, that's going to bring in like $1,875. That's pretty big, right? But we got a bullseye. We got a bullseye on our forehead that says if the price goes above 12,000, we may have to surrender our Bitcoin that we own because we'd have to sell somebody at the 12,000 level. So there is some risk involved with this, and there is some skill that needs to be applied in terms of knowing what to do. Selling calls caps our upside earning potential. So in exchange for that rent that we're getting, it caps our upside potential if the price trades above the strike price that we sold. It also gives us a little bit of downside protection, right? Remember that, say if we're sitting here at 9,700, 9.7K, and we sold that $12K strike for next week. What do we get? $45 of downside protection. If the price just dumps from here, we get this, we keep this no matter what happens. We keep that equivalent value of BTC, so we can start to chip away and really just collect rent on a regular basis. Sometimes what we can do is we can use this credit. We can use this credit to go buy a further out of the money put option. This is called a collar. So this is a call. Here's a put. It's a combination position. I don't want to confuse you guys today, but this is the wonderful thing about options, that we can use combinations of them. So today we're just talking about single options, and that's what I'm going to be focusing on for quite some time until we get to the point where we can actually use combination positions. So right now, my sense is that it's not going to be that feasible because the granularity is really poor, the spreads are wide. So we're going to focus on doing the simple income trades for right now. Downside protection is no replacement for knowing exactly where your exits are at all times. You've got to know this, guys. So a lot of people have already weighed in on options in the Omnia room, and they're like, I'm scared. Boy, this looks like I could eat my lunch. It could go to zero. And I'm like, okay, two things there. First of all, is you're assuming that there's no risk management. You're assuming that you're trapped into the position, which is not true. And secondly, any trade like that, if you just hold the underlying asset, if you just hold BTC, and if it drops, you're going to lose money as well too. So just the fact of selling options doesn't make things any worse or any better. It's just different. It never is going to be unfashionable learning how to manage risk on these trades. So quick application here on short calls, and then I'll take any questions that you guys have as we wrap up today's session. Do not consider using this as a directional bearish trade by itself. Do not. Only if you own the asset. This is called a covered call. If you own BTC and then sell calls against it, then that's okay. But it's not okay, and it will never be okay if you sell a naked call option. If you say, I don't have anything, I don't have any collateral against it other than the cash that's in my account. But you could literally get into a situation where you can get a margin call and you can lose everything in your account if we get a move that blows up to the upside. This is the account killer, is the naked call. Never, ever do a naked short call option position. I don't care who you are or what you have. It's possible to create limited risk through a spread strategy where you can buy one option and sell another. Okay, again, a little beyond the scope of today. I don't know if it's even feasible right now with the spread width that we have, as well as the fact that the limited risk with, we have $1,000 wide strike prices. That's a pretty good chunk, right? So the granularity really stinks right now, which means that we're just going to be doing single option strategies. We can use this as an income trade on a repeated basis. So you can do this. You can sell puts, and create enough of an account where then you've got enough BTC, you can start to rent that out. The odds are in your favor. However, risk of the combination position, long asset plus short calls, is still going to be unlimited to the downside. So what this looks like is, here's the risk curve, is like unlimited risk to the downside, and here's your break-even point, right? So the break-even point is going to be like right there. So here's break-even, and here's the credit. Here's the credit that you receive for the position. So the credit plus any upside accumulation for the underlying asset. So it will cap your upside. So this is where you have to be careful, because you don't want to, you want to kind of find that happy zone where you're selling far enough out, but also you're able to release that obligation if it starts to run on you. Risk management is and always will be the key. So with that, that is my presentation for today. And hopefully this brought some light to you in terms of the 4 major applications of how we can use options as either leverage or insurance, whether or not we're buying or selling insurance, right? Or we're renting out assets. So there's 4 different applications for this. To me, the best 2 are those where we're becoming the insurance company. And then once we get an asset that's big enough to rent out, we become the landlord. So we're an insurance company and then the landlord. We can be that at the same time, actually. So let me know if you have any questions, or if you're coming in after the fact, watching today as a replay, either shoot me a note, support@ReadySetCrypto.com, and ask the question, or it's even better if you just ask in the options section, which is in the Trading Pit channel in our Discord server. That's really what you want to do, because you'll have, besides me, you'll have other people that can answer the question as well too. And it's always good for people to post questions in there, because the question that you have may be one that several other people may have at the same time. And so you can help each other in there. Okay, any other questions? I don't know if I've put people to sleep here, or if I've explained things so well that there are no questions. So I'll just wait another few seconds here, and then I will wish you, and that's what I think I'm going to do. I'm going to wish you guys a great weekend. Thanks for listening, and hopefully this was enlightening, and look forward to that class, which starts next week. All right, thanks everybody. We will see you guys soon. Have a great weekend.